Good afternoon. This webinar offers closed captioning. To enable closed captioning, click on the live transcript button on the bottom of your screen and choose your preferred method. Welcome to the City of Chicago Department of Business Affairs and Consumer Protection webinar. Please note any website or email that I mention will be posted in the chat box. For those seeking business licensing assistance, you could visit the Small Business Center at City Hall on the 8th floor or call 312-74-GO-BIZ. Also, business licenses can be applied for or renewed online at chicago.gov/business licensing. The BACP Entrepreneur Certificate Program now has a new portal. If you are already a part of the program, your account will automatically reflect the credit for joining this webinar within 24 hours. If you want to learn more about the program, please visit chicago.gov/BACP certificate. Also, this webinar is being recorded and will be available at youtube.com/ChicagoBACP. I will post the mentioned information in the chat box. We encourage attendees to ask questions. Please use the chat box to send your questions. There will be a Q&A session at the end of the presentation. Please note that the views, information, and opinions expressed during this webinar are solely those of the presenter and do not necessarily represent the official policy or position of the Department of Business Affairs and Consumer Protection or the City of Chicago. Today's webinar will be Fund Your Startup into a Real Business, presented by SCORE Chicago. Tram?
Hi, I represent SCORE. SCORE is a nonprofit association dedicated to helping small businesses get off the ground, grow, and achieve their goal through education and mentorship. We've been doing this for more than 50 years, and because our work is supported by U.S. small business administrations and thanks to our network of more than 10,000 volunteers, we are able to deliver our services at no charge or at a very low cost. And today, our presenter is Jeff Nicholson. Jeff, with over than 33 years of commercial and investment banking experience, he is responsible for client coverage activities of diversified company in the central U.S. He has had opportunities to observe and work with managers and owners across the wide range of industries, from large public multinational to small privately held companies. During 17 of those years, he was also a successful adjunct instructor at both undergrad and graduate levels in both management and finance. Jeff.
Thank you very much, Tram. Good afternoon, everyone. I will be your guide today for financing your startup, and I very much appreciate everyone listening in. You know, when I was first asked to put this webinar together, I thought, all you really need to do is to sketch out your great idea on a napkin, and people will just start throwing money at you. Well, you know, that's not really true. This is more like it. Money is like gasoline during a road trip. You don't want to run out of gas. Now, this quote was made by Tim O'Reilly, who was the founder of O'Reilly Media. And you may not know that, but O'Reilly Media was the first internet web portal back in 1993. Our goal today is to learn a lot more about funding startups. And frankly, most people who claim to know don't know diddly about it. So we are going to cover a lot of material. We're going to go a mile wide and an inch deep, so please strap yourself in. Let's step back and first think about the big picture. Look at these stages during the life cycle of any startup business. There's roughly 9 stages in that cycle. Now, this workshop is only going to deal with the 5 highlighted stages shown with the red halo. Now, most of the financing stuff you can read, most of the stuff you can find on the internet, and most of the workshops you can go to are all about the other stages that are not highlighted on this chart. Why? Because the term startup is often used for a business that's already successfully launched and remains alive for up to 2 to 5 or more years. So you could be talking about startup financing for companies that are 7 years old. Well, that's not our focus. We're focusing strictly from where the idea stage begins and where your company breaks even after launch. So let's dig in. Inc. magazine went to its 500 founders. That's the 500 fastest growing privately held companies in America, and asked them to think back on their first year in business and identify what was the biggest mistake or biggest challenge that they faced. And here's the result of that survey. Shortage of capital was the number one answer. And notice how distant number two was. So the number one challenge is not enough capital. Now, I know what you're thinking. You say, okay, that Inc. magazine was 10 years ago, and you wonder if that's still relevant. Well, here's the result of some diligent work done just a couple of years ago. CBI Insights, which is a private analytics platform, they provide market intelligence about private companies and investor activities. But it's a pretty big data company. And so the Startup magazine worked with data that CBI accumulated on 350 startup failures. And they analyzed the failures. And the results of that work are displayed here. Notice that the two biggest reasons for startup failures are all about funding. The startups either ran out of money or couldn't find financing when they needed it. Now, the SBA estimates that the average cost of starting a new business is $35,000. Now, storefront businesses may require 2 or 3 times that. But most businesses are able to launch successfully with well under $100,000. A sound business plan includes specific financial projections, including total startup costs. And estimating startup costs, as you'll find out, is as much about forecasting sales as it is about expense projections. And investors and lenders that you may go to will want to know specifically where their funds are going to be used in the business. So for me, you should begin the financing search with yourself. No one else is going to invest in your business if you're not willing to invest in your business. And we call that bootstrapping. After that, you have to get out a pad of paper and begin to list other sources that you might want to tap. And the key objective of this webinar is to help you formulate that list of possibilities. And what form will the funding take? Will it be donation-based? Will it use loans? Will any of the funds come from sources that require an ownership stake in the business? And as you're pulling your thoughts together on these sources, you also need to cultivate a funding strategy. And by strategy, I mean the mix of resources that you're going to use, and I mean plural, the specific milestones in your journey that determine how much and when the funding is needed, and how do you plan to approach each source in order to solicit the money that you need. Now, if you return to that survey at Inc. magazine, one of the other questions they asked was, how much money did you use to start your business in that first year? And if you look, those answers aren't far off from what the SBA said. Only 18% said $50,000 or more. And well over half said less than $10,000 to start the business in the first year. Now, continuing with that Inc. founders research, what sources did they go to? Well, here's the list. And 71% of those founders used personal savings. That's, again, what we call bootstrapping. 21% used family and friends, and we're going to talk about that. And if you lump together both personal and home equity loans together, that was 25%. But notice when you're doing that, you're putting your own personal assets at risk, not just the business. And then 9% was angel funding, and we will also talk about that. But you'll notice on this slide, there are no bank loans, and we'll get into that a little later. Now, with that as background, you might be saying, well, how do I get started now? Well, I would start by trying to get answers to these two questions. How much money is needed, and how will it be used? What do you think are startup costs? Most people make the mistake of thinking startup costs only accumulate until the business is launched, and that's not correct. It's cash outlays until break even is reached. Now take a look at this chart. On the far left side is day one of business, when it was launched. And then as you go to the right, that's the amount of time and the number of sales that occurs. But break even doesn't happen until you reach where that yellow arrow is showing. And until you break even, you also need to cover or fund any operating losses in your business until your dream becomes profitable. And to be able to complete the exercise, in order to get you to where that yellow arrow is, you must be able to forecast sales or revenue. Now, going back to what we're talking about here, again, you have to put your projections together until you get to break even. But that also includes capital expenditures, which don't show up on your income statement. So if you're going to pay cash for a copy machine, for example, that's a capital expenditure, and it doesn't show up on your income statement. Again, you got to cover your operating losses until you break even. And then there's another component called net working capital. Now, let me describe what net working capital is, because that's a very important component of cash flow of a business. But again, it doesn't show up on your income statement. Let's assume you're making something. So you need to buy some raw materials. So on day one, you reach out to ABC Company to buy the raw materials you're going to transform into a finished product. But because you're a startup, they're not going to give you any terms. So before they ship anything, they're going to want you to pay. So you're going to have to pay up front day one when you make the order. Now, it might take a week for them to assemble what you've ordered and ship it to you. And it may take another week or two before you get the shipment. Once you get the shipment, now you're going to transform it into a finished product. You're going to manufacture it. You're going to do quality control. You're going to put it into packaging. You're going to put it on the side so that you can sell it. And that whole process may take anywhere from 2 weeks to 4 weeks to complete. And then you've got to sell it. You've got to ship it to the customer. And then the customer's got to pay you for it. And sometimes, if that's an established business, they're going to want terms like 30 days net. But if you think about it, your money went out the door day one. And you've got 4 to 6 weeks of time before you've even made a sale. And you're not going to collect from your customer for another 30 days. That working capital has to be paid for. And that's on top of any operating losses in the business. So you're developing really two sets of financial projections. One is the one-time startup costs, your new website, the brochures, new business filing, all the legal costs that go in. But then you've got your monthly operating expenses until you break even, or your net operating expenses until you break even. And if you are household is going to be dependent upon the cash flow from your business, you also need to add your personal living expenses into factoring in what are startup costs. So again, you have to cover your losses, your capital expenditures, your net working capital until you break even. After that, you start turning a profit, and that's where you want to get. Well, here's some things to think about as you're pulling together what you believe are your startup costs. The first thing is to think about planning for contingencies or the unexpected. You know, if you're building a commercial building, for example, and you want the bank to finance the construction, you've got engineers and architects that have a great deal of experience. You've got contractors that have built many of these things before, but the bank is going to require some contingency in the budget for what's unexpected. It may be between 8 and 12% of the cost of the building, but they're not going to fund without that unexpected contingency. And so you should plan for that. Don't skimp on necessities. Avoiding paying for insurance, for example, is some things that people say, well, maybe I can save money on that. I would advise against it. And you can always consider ways to economize or later, but you should definitely get a reality check or two. And that's where a SCORE mentor could really become an important factor. You go to them with your assumptions behind the numbers, you talk about the numbers and get their feedback. And it's important to get, you know, at least 2 separate sets of feedback on how realistic your assumptions are and the resulting numbers are, and putting that together. Now, the other thing I'd like you to do is to write this down. www.5minuteclasses, all one word, 5minuteclasses.com. You're going to be looking for, on that website, a YouTube video on how to calculate startup costs. It's a really good video. It's only 5 minutes. And they also have some suggested worksheets that might help you compile that information. But the big thing here is if you don't have enough cash to start your business right, wait until you do. And again, as a reminder, if your household is going to be dependent on the business, you need to make sure that your household expenses are included in that startup calculation, because that's going to require funding. Now, to help compile all of this stuff, you can download what I think is the best Excel spreadsheet for financial projections, and it's free. You just go to www.score.org, and in the search box, put in financial projection template. And the search result will show an Excel workbook, which you can download for free. It's got input sheets where you can enter in all your assumptions, and it will also provide some assumptions on what some of those numbers should look like. But you can also download a 40-page user guide. And that's very helpful in helping you think through how to put all this stuff together. And there's also a complete sample workbook on the website, which you can download. And I believe it's Ann's Nursery. So you can see all the stuff that Ann put in for her nursery startup, including her personal financial statements and all of her assumptions. But once you complete this, the spreadsheet generates income statements, balance sheets, cash flow statements. It even has a break-even tab that you can look at that shows you how many units you have to sell to break even. And it provides you also with ratios and ratio analysis, which might be very useful in approaching a lender or an investor at some point in time. And I don't believe that there's a better Excel workbook on the internet today, and it's free from SCORE. Now, we're not going to go through the workbook in this webinar, but you should learn to use Excel and certainly use this template for pulling together your business plan. Now let's switch gears for just a minute. The likelihood that your startup will get financed by a bank is slim to none. I hate to tell you. In over 30 years of banking, I only financed one startup. And it was a startup, they needed $1 million up front, and we granted the loan on this basis. One of the founders had a father who had a stock portfolio that was worth $1.5 million at the time. And so we required that they deposit all of those stock certificates with me in our vault, along with stock power signed over to me in the bank, so that at any time that we began feeling uncomfortable about the way the business was going, we could sell the stock and pay ourselves off. That's the only startup loan I ever made. To realize how it's difficult for a bank to lend to a startup, let me help you understand how a bank thinks. Let's start by pretending you're an investor in stock in a public company. So put your investor hat on. You invest or buy stock in a public company because you want to participate in their upside, right? You want to buy stock in the next Google, the next Amazon, right? But you know that if you buy the stock, if the company goes bankrupt, you could lose everything. But you take that risk because you hope to participate in the upside of this company at some point in time. Sell the stock and reap the benefit. Now take your investor hat out and let me put a banker's hat on for you. When a bank lends money, it could lose everything too, right? If the company goes bankrupt. But if it does lend money, the bank doesn't have an opportunity to participate in the upside of the business. Its upside is limited by its interest rate on the loan. So whether or not the company, is successful enough to pay the loan back or to become the next Google, the bank is only limited to its upside to the amount of interest that it will make over its cost of funds. And because it can't participate in the upside of the business, a bank wants to be assured that it can be repaid in two ways. They want two legitimate sources of repayment. And the first is always the cash flow of the business. So they're going to take your projections, they're going to look at your assumptions, they're going to examine other businesses that they know in your industry, and they're going to make comparisons and see how valid your assumptions are. And they're going to take some haircuts and make some assumptions to look at a downside if you don't achieve your expectations. And if you can achieve paying back the loan under those circumstances, then you have one source of repayment. But they're looking for a second one. And typically, that's the liquidation of collateral. And so they take a look at the accounts receivable, they take a look at the inventory that's there, they took a look at equipment and real estate if you have it, and then they determine if in an auction, how many of these receivables can we collect? Can we collect 75 cents on the dollar, 80 cents on the dollar? For the inventory, for finished goods, can we get 50 cents on the dollar? And for the raw materials, could we sell them back to the supplier for 40 cents? If we have to sell the equipment, can we get 60 or 70 cents on the dollar? They add that all up. And if that's not enough to cover the loan, they won't make it. If it is a reliable second source of repayment, that's when they make the loan. But you see, a startup doesn't have any collateral. A startup doesn't have a demonstration of cash flow. It's all starting from zero. So the bank is just not in a position to take that kind of risk. And that's why they don't lend to startups. So where can you go? Well, this is the beginning of a list. These are the sources of capital that you can get access to. And as I mentioned earlier, you should be thinking about multiple sources, not just one. Now, if you look on the left-hand side, that's sources of capital that are equity related, which means you're going to have to give up a share of your business in order to get that money. And then on the right side is debt, which typically doesn't signify ownership, but you have to pay the loan back through cash flow from the business. Now you'll notice that there's an asterisk down here, guaranteed by SBA. And that is what the SBA often does, is it guarantees a loan to a bank or a portion of a loan to a bank. And so let's go back to that working capital example I gave you before. And let's assume that the bank goes through its analysis and says, yeah, I think there's enough cash flow in the business to pay us back, but we think that there's a weak collateral position. We don't think we can get paid back through liquidation. And that's where the SBA comes in. The SBA says they'll say, we'll guarantee 75% of the loan. So now the bank says, well, wait a minute. We've done our analysis on the collateral and we think we can get 50 cents on the dollar, which is inadequate. But if the SBA is going to guarantee 75% of the loan, that's 75 cents. So if we add the 50 to the 75, now I've got $1.25 for every dollar of the loan. That sounds good to me. Let's make the loan. It's got good cash flow. Now we've got enough support as a secondary source of repayment. So that's what the SBA does. Now, I know this slide looks very, very busy. Bear with me, you're going to see this a number of times. But during the Great Recession back in the early 2000s, I put this slide together to present to a number of existing Chicago businesses that didn't feel that they had adequate access to conventional bank financing. If you think back to the Great Recession, bank financing basically shut off at that time. So this shows a myriad of sources of capital other than a bank. There's not a bank on this chart. Now we're going to focus on those clouds that are highlighted in grayish blue. Those are the ones that have potential applicability to startups. Again, remember, we're talking about a startup from anything prior to breaking even. Now, the other clouds are typically applicable to companies that have been in business for longer periods of time. And by longer, I mean, generally speaking, having at least a track record of 2 years of successful operation. For example, alternative lending down here, on deck, for example, that's shown, that's a public company. It's probably the largest alternative lender in the US. You can't even apply for a loan with them unless you have been in existence for 4 to 6 months. But these guys are looking for consistent monthly revenue, and most businesses don't get that until they've been in operation for 18 months to 2 years. So anyway, we're going to focus on the gray clouds, and let's get started with micro lenders right at the top. Now, micro lenders are primarily intermediaries between sources of funds directed towards disadvantaged areas and the actual financing needs of those areas. And that's why these operations are not for profit and they operate very locally. The Community Reinvestment Act requires banks to lend to disadvantaged areas. So banks contribute funds to micro lenders and even participate directly with them in lending to companies so that they can get CRA credit and pass that federal test. These micro lenders are typically certified by the US Treasury Department, and they're certified as Community Development Financial Institutions, or CDFIs. and there are 950 of them in the US today. And some programs also get support from the Small Business Administration through the SBA microloan program. And in this case, that program, the SBA guarantees up to 85% of the loans extended. And there are 32 such lenders in Illinois today. The key here is that your business needs to qualify because of low income or disadvantaged areas. So microlenders are typically very friendly to minorities and to women. And unlike banks, they are much more friendly to startups. Now, my experience with microlenders is that much of the lending is directed towards real estate and real estate development. But it is also available to startup companies for working capital financing and for equipment purchases. Now, some of the loans are secured with collateral, and that's especially true with the real estate. Sometimes co-signers are required, but in many cases, the loans are unsecured. Typically, those loans are for $50,000 or less, but the rates vary greatly. They can be anywhere from 4 to 36% across the country, depending on who you're looking at. Now, if you look at the micro loans guaranteed by the SBA last year in 2022, the average loan was $13,000. I know I got 2019, but I got an update. The average loan was $13,000, and the average rate was 7.9%. And the rates averaged, oftentimes between 8 and 13 otherwise. But you have to recognize on that busy schedule I showed you earlier, I listed Axion, Chicago Neighborhood Initiatives, Microfinance Group, and CFA USA as probably the 3 biggest micro lenders in Chicago. And to find out more about this whole program, you can go to the CDFI Coalition, which is cdfi.org, or to the Opportunity Finance Group at ofn.org, which is a group of CDFIs that have pooled their resources together to make loans to companies, including startups. So microlending, a very viable source of capital for startups, and you just have to make sure that you can qualify based on where your business is located in the situation that you're in. Now, the second group we're going to talk about is family and friends. And you might remember that 21% of those Inc. companies, the Inc. 500, they got funding from family and friends. You might not be aware of this, but family and friends invest between 50 and $75 billion a year in startups. That is 2 or 3 times the amount invested annually by venture capitalists and angel investors. So family and friends is really an important component, and most people often think about shying away from it. Now, as a participant in this webinar, you will receive as a follow-up SCORE Chicago's Family and Friends Funding Guide. It's a 5-page write-up that kind of walks you through all the details in thinking about this whole source of capital for your business. It's a really comprehensive but abbreviated piece that I think you'll find very helpful. But the trickiest part of this is that you really don't want to lose money that family and friends have invested in you, right? I mean, so you're walking this emotional tightrope by mixing business with family, which my dad said never do, but he was not right. So my advice is to go only to the people that can afford to lose the money that they invest in you. And I think this is the most heavily weighted criterion. As a frame of reference, Pension funds and other institutional investors typically will allow their principals only to invest 5% or less of the total capital in a portfolio to risky assets. Now, you might not believe your business is risky, but as a startup, it really is. It's in that category. So friends and family members should be kept to a similar guideline and should be asked to invest only that small portion of their net worth. So if Uncle Fred has a net worth of $100,000, you should only be asking for Uncle Fred for 5% or less of that, because that's the only amount that he can afford to lose. So you should also target people who are sophisticated and well-connected. Those are the people that are going to ask you the tough questions, and they will ultimately benefit your company in the long run. Better yet, aim at individuals who have experience in running their own business. They really understand what you're going through. If a family member or a friend has invested in an early stage or startup before, that's another great target because they've already dipped their toe in the space. They're familiar with the territory, and that would be a great target. But what you want to avoid is what I call taking dumb money. You want your seed investors, your early investors, working for you to help the next round of funding, if you need it, to happen. And they're likely to help you because they've already invested money in you. So you don't want to press anyone who's uncertain because they will be the first ones to complain when things get rocky. So avoid investors or lenders that have a high potential for drama or stress. But once you get a target or two, I suggest that you first build a relationship, a business relationship with this party. I would ask them first for their reaction to your startup concept. You'll be better positioned after you've debriefed and talked about it to ask for money later. But you have to be prepared. You have to have a decent business plan that includes a validation of the market for your product or service and also includes financial projections. And milestones could be used for triggering events. This would allow a series of smaller funding requests and communications on the progress that you're making. And we'll get back to the milestones in a minute. Now, most of the capital that you raise from family and friends will take the form of loans. They'll want to be paid back. But you're going to have to decide if that works for you. And the family and friends handout goes into detail about what's the difference between getting a loan from a family and friends or taking an equity investment that gives up part of your ownership to that investor. You want to be sure that you demonstrate your passion and especially your due diligence in the business. That gives confidence to the family and friends person that you've done your homework, and you really want to demonstrate that you've done that. Having a great idea is one thing, but proving that your idea is viable is another. So while you want to be upbeat and you want to be respectful, you also want to be able to demonstrate the viability of your plan with some market research feedback. Also, managing expectations is really critical. And I think it's really best practice to keep a periodic email or meeting update for all your backers. You want to be honest about what's going well and also what could be doing better. You want or need to come back to them for future funding. So you want them to have confidence that you're being straight with them. Remember, no lender or investor wants surprises. So endeavor to alert each supporter if any suspicions to changes in the plan occur, because that early notice is what they will gain respect for you in the process. Now let's just talk about this milestone idea. That's again where you're carving up the litany of things that happen in your business so that you get a series of funding requests as you go along. And this is not just a list for funding, but it's also a list that gives you an idea of what the milestones in your business plan should be and what you should be looking forward to. So for example, proof of concept is when you demonstrate that your product is technically feasible. So that's a way to say, hey, this thing can really work. And so I need some money to pay for the next stage in my business. A key partnership is another great one in my mind. And so you're going to maybe be securing services for distribution or for marketing assistance. And so once you sign a contract with a marketing company that's, let's go ahead and say, assemble all of your social media stuff together so you have a unified platform, that's when you can go back to your family and friends, say, I've got this marketing person that's going to consolidate all that, and the contract is going to cost me $1,500. I could use some help. Prototype is another one where you've actually developed a product that works and that you want to sell. Today, minimum viable product is often used in lean startup processes. So this is where you develop an actual product or even a video of what your product is that has not 100% functionality, but is something that a person in a focus group or in an interview can actually touch and feel and understand a little bit about what your product is. Once you've completed that, that's another chance to secure some funding to pay for what the construction of that was. And again, having your first sale, reaching a certain number of customers, all of these are milestones that you can set out with a member of the family and friends and say, once these are met, then you can unlock your pocketbook to fund the next stage. And since they know what the milestones are in advance, they know what the next stage funding is going to go for. And that's another way of building a plan with somebody who's in family and friends that I think is very effective. Now let's go to donation funding. Donation funding is a subset of crowdfunding. And crowdfunding is what? Raising money through an internet collective, and it's coordinated through the platform. The nice thing about it is that any money raised through donation funding doesn't have to be repaid. It's a gift. And donation funding has helped more than 1 million companies launch since the year 2000, when it really came into force. And the biggest players are listed on this slide, from Kickstarter to fundraiser. Now, the one thing you need to recognize is that you might have a really good focus on a business plan, but that's not going to necessarily help you much with donation funding. These platforms attract donors they're really interested in projects or causes, not businesses specifically. So you kind of have to change your thought process to align with the platform's population. And you have to have a story that really connects. I give you this, to me, as a great example. There was an entrepreneur in Chicago who wanted to start a business to transport school children from working parents back and forth to school during the week. Now, if any of you have children and you're both working, you know it's really a headache to get children back and forth to school. And so she wanted to start a business that strictly focused on doing that for working parents. And when she went to go get automobile insurance, the insurance companies all labeled her a limousine service instead of a child transport service. So they required a $10,000 upfront premium in order to open the policy. Well, she didn't have it. But she went to the funding sources for donation, And what she basically said is, I'm looking to do some great things for working couples here in the city, and the big bad insurance companies are holding me ransom for this upfront payment, which I don't think is fair, but it has to be paid. I need your help. It was a great story. She got her money. Now, donation funding does take a unique approach. And most of the time, people that are donating are looking for some form of reward for their donation. They know they're not going to get paid back, so they're looking for a donation. Sometimes that's pre-ordering. It may be a discount on the first run. It could be recognition with a t-shirt, be on a published donor list. But most of them are looking for some kind of reward program of some sort. So that's something to keep in mind. So you're going to have to evaluate the platform assistance that's provided for you for that campaign to be able to gauge which of these platforms are best for me. But you shouldn't look at this as a one-time event. You should treat the givers or donors as stakeholders that you might want to go back to in the future. So it's not necessarily a one-time shot. The platforms give you the donor lists, the dollars that are given. They have vehicles to gather contact information from them. They provide updates. They take surveys. So they have all of the networking all set up. So going back to the donor population again can be very successful. Peak Design, which is a creative maker of outdoor gear, they went back 5 times for one of their products. And their 5th time they went back, they raised $4.9 million. So think about this as a long-term stakeholder. But I will also say that you need your own outreach program to attract people to the donation website. I can't stress this enough. You cannot rely strictly on the platform itself to get everything that you need. So you should talk to all your family and friends. You should talk to anybody that would listen about your business idea and the donation idea that you've got, and attract them to the platform, because that is a necessary part of making sure that you get the money you need. Now, the fee schedules are on 2 basic categories. One is a fixed, where you've designated the amount of money that you want to raise. But if you don't get that last dollar, so if you want to raise 20,000 and you get 19.9, you get nothing. You get 0. The flexible plan is different. You get to keep whatever you've raised, but typically the fees are going to double potentially, depending. So, I mean, the platform is expecting a certain return for the assistance they're giving you and the campaign they're running for you. If you don't get everything you want on a flexible plan, they're happy to share what you've raised, but they want a higher percentage to make up what they think is the difference. And with all of the donations, there are transaction fees that occur. So there's banking fees and charge card fees and all that, and you're going to have to cover that. And that's typically 1.5% to 3% or more of the dollars that are raised. Now, it's interesting that the all or nothing campaigns get fully funded at twice the rate of the flexible plans. And if you think about it, it makes a lot of sense, doesn't it? Because if a fixed program, if you don't get your bogey, you get nothing. You're going to work extra hard to make sure that happens. Whereas in a flexible plan, well, if I didn't get everything I wanted, at least I'll be happy with what I get. And so remember, you're really going to have to work hard on a fixed plan by going out and doing your own outreach to make sure you reach that level, because that's a real critical thing. And that incentive of 0 is what creates that double funding success. Now, fully funded success rates in crowdfunding overall is only 50%. but 78% of all kinds exceed their goal. Now, the average campaign raises between $25,000 and $30,000, and that time frame usually takes 9 weeks to complete. So it's not a very short program. From the time you begin, create the campaign, reach out to your network, get the feedback, complete the campaign. It's usually about 9 weeks on average. The average pledge is only $100. And overall, 47 backers fully funded plans usually have 300 backers. The biggest raise ever was $20.3 million on Kickstarter back in 2015. Pebble Technologies was promoting its new smartwatch, and they wanted $500,000 for a marketing campaign. And they raised over $20 million. Fitbit bought Pebble Technologies 2 years later, by the way. And the other thing to really mention is that fully funded projects that have videos earn 100% more than those campaigns that don't have them. So now you have an idea of, who are the big funders, what are the different programs you can use, what you can expect in terms of dollar amounts and what you might be able to net. So that kind of closes off the donation funding. Now let's jump to angel groups. You know what an angel is? Angels are usually wealthy and successful business people who are interested in investing their own money in startups and in early stage businesses. Sometimes they work alone, and sometimes they're part of a group. If any of you have ever seen Shark Tank, that's an excellent example of angel investors. That's who they all were angel investors. And this slide shows the top 7 angel investors in Chicago today. Now, there's a big difference between individual angels and angel groups. Angel groups are much more formal, and they often anticipate investing into a situation that is part of the next unicorn or IPO. So they've got their eyes set on meaningful upside as a group. So seed capital, which is what's often referred to as the first level of funding stages. Angels are invested in providing seed capital, and they're typically more interested in ownership or equity ownership than they are in providing debt. And if they ever do provide debt, typically it's in a convertible form so that at some point they can convert it into equity if certain milestones are reached. But angels aren't interested in day-to-day operations. They want you to run the business. They're routinely satisfied with a minority position, meaning, much less than 50% of ownership. Could be as low as 10, could be, anywhere to 40. And they're probably going to want to have some board positions so that they can participate in some of the key business choices that the company has to make. But their time horizon is shorter than a lot of other potential investors. So when they invest as an angel group, they're looking a 2 to 5 year time frame. That's pretty typical. So they really want to get out either partially or entirely within that period of time, and then take that return and invest in the next opportunity. Now, the average individual investment is less than $40,000. So if you have a shorter time frame, then an angel group is good. If you've got high expectations going forward, an angel group is good. But the individual investor, be thinking about that average $40,000. Now, if you've ever watched Shark Tank, you know that the the valuation of the business is crucial to success in raising the money, right? Now, we could spend an entire webinar on valuation, and we're not going to do that. But you should know that in order to have a decent conversation with an angel investor or an angel group, you're going to have some pro forma valuation in pocket in order to have a conversation with them. Now, oftentimes angels see themselves as filling the gap between family and friends and venture capital firms. They look at themselves as being that intermediary, and more are not interested in even considering an investment if you haven't raised money from family and friends. After all, those are the people that know you the best. And so they're using that as a big screening device. If you can't get anybody that you know or in your family to invest at least something, why should they even think about it? That's a growing criteria in the angel world. Now, I believe there's a greater chance of landing an individual investor if your business plan is not targeting a near-term IPO. So if you're looking to keep your company private for a while and you're looking to grow over a long-term period of time, then an individual investor is your best bet. But if you're looking for someone that's going to be providing mentoring support and your time horizon is short and you're looking for a lot of money and grow quickly, then an angel group is going to be where you're going to get the best value for the time that you spend. And this is a list of those things that are important in order to approach an angel group. So your product or service is developed or near completion. You have existing customers or confirmed orders from potential customers. You've invested your own capital and have recruited family and friends. And you can demonstrate that the business can grow rapidly in the next 2 or 3 years. So you've got to be able to provide them with the market validation of your product or service that's convincing, which means you have to do some market research and some investigation, but that will be a very key part of it. And your business plan has to be in top shape. Now, as I said, while you might be best suited for an individual angel if you've got a longer time frame, the fact of the matter is it's easier to find the groups than the individuals. So I mean, you've already got a list of 7 in Chicago. So what's the way to get to an individual? Well, the first thing is you've got to get out there and network. You've got to really be talking to people. That's where LinkedIn can become a great avenue for that. You get on LinkedIn and you start networking with people that are involved in angel financing. And that's where you can begin to get introductions to people that will allow you to make a presentation or at least make an introduction. Now, the largest trade association in the angel arena is the ACA, the Angel Capital Association. And if you go to their website, it's a great source to find studies, characteristics about what angel investors are, white papers that you can read about the angel environment. It's really the ACA promotes angel investing across the United States. So it's the trade association that collects all this stuff. It's a great source. Angel.co is a place, believe it or not, that you could post for a job or recruit for your startup. So if you want to work for a startup, angel.co is a place to go. And if you're a startup and you want to recruit individuals that are interested in working for startups, that website is a good one to go to. But if you go to angel.co/North America Investors, you'll find a long list of individual investors in North America, and you can sort through that list. That's where you can kind of dovetail with LinkedIn to see if there's anybody on that list that know somebody that you know and a way to make an introduction, that's another source. And the last one is the largest angel funding platform, which is Angel Investment Network. And that's where a group of angel investors have gotten together a group has formed this in the angel world. And this one boasts, I think, 1 million investors across 80 countries. So it's the largest platform around. Again, it's something that if you're looking for or interested in the angel arena, this is a good place to delve into and see, what's out there. You need to know what's out there. We've talked about micro lenders, family and friends, and angel investors. All three are very viable sources for startup companies up until they break even, and even after, but certainly for that period of time. So delving into those is really, really important and something you should look at. Now, over the last couple of years, people have asked about credit cards, business credit cards. So I've kind of added this section to talk about that. And indeed, business credit cards can indeed be helpful for startups. But first, you have to assume your business has launched successfully, but you're short of break even. And so long as you have a personal credit that's healthy and you have income that can prove that you can pay your bills, obtaining a business credit card during the infancy of your business is not particularly difficult. You can do that. But by healthy, I mean a minimum credit rating between 670, 690. And so if you're that or over, then you just need to focus on, can I generate enough income to pay my bills? And that would probably get me a card. Now, most business credit cards require that the holder, remember, this is issued to the business, not to you. So despite that, most of the credit card issuers are going to require a personal guarantee from you. And that's going to mean you're going to have to take responsibility personally for any business expenses, because they'll come after you in order to collect. And when they do their credit check, they're probably going to do a hard pull, and that's going to drop your score by 5 or 10 points, but kind of expect that. So if your rating is good and you can demonstrate adequate income, having a business credit card is really a viable means to get funding for your startup. And virtually all business card applications are made online. You're going to be asked to provide the legal name of your business, its address, phone number. Is it a corporation, LLC? What's the corporate structure? What kind of industry is it in? Number of years in existence, number of employees, annual business sales, all of the sort of things that you would expect to provide on a detailed application. And because you're guarantor of the debt, the issuers also want to know about you. So they're going to all your personal contact information, your gross annual income, all that stuff, and they're going to check your credit score, as I said before. But what if you haven't launched yet? Generally, you need a business to open a business credit card. I mean, that seems somewhat sensible. But what exactly is a business? It is possible to get a business credit card if you earn money independent. Now, this could be your current job if you still retain it. Maybe you have part-time income. Maybe you're doing some freelance writing or selling goods online or doing consulting or whatever. Any other outside activity aside from the business can be included as income. So in this case, you list in this as a sole proprietor, you put yourself in the business tax identification section and then use your own social security number rather than an employer ID number. And so you don't necessarily have to run a company to get a business credit card. But these business credit cards are designed for business expenses, which include startup costs. And so you have to make sure you're not using them for other personal reasons. And typically those APR rates are between 20 and 30%. So they're pretty much up there. For many startups, a business credit card can be difficult to obtain without adequate personal credit. If you have bad credit or no credit, let's face it, your business credit card options are severely limited. But you're not without options in using a card as a vehicle for making payments. A secured business card may be of some help. So with a secured card, you open your account with a security deposit. Usually it's somewhere to a minimum of $200 to $500. And upon approval, your credit line will be equal to that deposit amount. But think about this. What about going to a family and friends person and asking for them to provide you the funds to put in that business credit card deposit in that secured card? That's where you can get some extra mileage from a business and family friends connection. To learn a little bit more about this, write this down. Go to www.creditcardbroker, all one word, creditcardbroker.com. And when you get to that homepage, go to the bottom of the homepage and look for an entry that says secured credit card and click on that. And that will give you a great deal of information with some videos and some other platform information that talks about secured credit cards and how they can be used and what the issues are with them and how best to leverage them. You can also try to get a business credit card with a co-signer. Now, this doesn't happen very often because it's not very typical with business card issuers, but they are out there. And that's, again, where a family and friend could become a co-signer to get a business credit card and provide that as a source of repayment. They're not outlaying funds directly. They're providing some guarantee support by being a co-signer, and you have the ability to, have your business run and to pay those charges without having to tap into your family and friends' contact. The only other thing I'll mention is that if you have a very trusted friend, you could ask them to make you an authorized user of their account. And most credit card issuers will issue a card with your name on it as an authorized user of somebody else's credit card. So then you could go ahead and use that to charge. From a technical standpoint, you're not legally responsible for those charges because it's on your trusted friend. But obviously, you need to work out the details with them. But again, that's just another way of trying to look at business credit cards as a vehicle for transacting business or funding activities within your business that's viable. So I hope that's helpful. One thing I'll caution, though, is that while most credit card companies will ask for your income, the verification often doesn't happen. And that's just the reality. So what happens if you exaggerate your income? Well, that's called loan application fraud, and you don't want to do it. If you're ever convicted of that, most issuers will use a class 4 felony, and that has a prison sentence of 1 to 3 years and up to a $25,000 fine. You can go up from there. The maximum, which I've listed here, is $1 million and 30 years in prison. Probably we're talking about a big operation versus an individual. But the point is, it's obviously critical that you become very honest and accurate about your income information because you don't want it to come back to bite you. And the other thing I'll mention is that in Illinois, the State Police Bureau of Identification, if you're ever convicted of loan application fraud, they report that. and they report that to employers. They will, when you go to get a future job, that will be in the database. They'll find that as much of their background search. So make sure that you're honest. I just want to be open about that. Now, let's go back to the sources that we didn't cover. Again, these are sources that are typically available to businesses that have been in operation for a long time and more established businesses than startups. And startups, again, in this webinar is up until break even. Now, equipment finance is a potential exception there. If a manufacturer of the equipment that you want to buy has a leasing arm, that might be an available source of financing for you. I mean, the manufacturer knows the value of its equipment better than anyone. They also know its depreciation value better than anyone. So they will structure any kind of leasing deal so that they will be able to pay themselves back if they have to repossess what you've bought. And the other thing to remember is that leasing is 100% financing. So you typically don't make a down payment when it comes to buying a piece of equipment through a leasing company. They're doing 100% financing. So pay attention to the manufacturer of any equipment you're buying and see if they have a leasing arm, because that might be available to you before you break even. And factoring is another one that's potentially possible if you're there with a large receivable from a big company. Because what a factor does is it will pay you for an invoice to a big customer that's creditworthy, where you can get anywhere from 75 to 80% on the dollar day one, rather than waiting 30 days to get paid. And that's what a factor does. They pay you up front and then they collect from the end user. Now, you'll also notice that there's Lendio.com and Fundera.com that's on here. These are two, what would I call them? They're platforms that give you access to multiple sources. So you go onto Lendio, for example, and you register your business and you talk about, what you're looking for, and they will give you access to lending options like equipment finance and alternative lending. They've got direct access to these things, and you can get access to those platforms through these coordinators. And again, it's more for established businesses. But I share this now because I think it's useful to understand that once you break even, there still are things that you can do to finance your business, before you have access to banks. And like Lendio and Fundera, the Illinois Investment Network is also a web-based portal that matches investors and entrepreneurs. Now they've got a non-commission or no commission service that they have. So it's kind of bare bones, but their fees, if you pay for it, they start as little as $149 for a period of 180 days, where you can access all sorts of investors that are part of this network. But again, that's more for established business. I'd like to go back to that alternative lending because it gets advertised a lot. You've seen On Deck and Cabbage and all these guys on the radio, TV, and on social media. And the lines on social media, crowd lending, alternative lending, that's been blurring a lot. But alternative lenders are looking for consistent monthly revenues. And the reason is that they take payments out of your account every day or every week. So they want to make sure that the revenues are coming in on a consistent basis so that they can take their piece every day or every week. And so if you have very infrequent revenues, this just doesn't work. And usually you have to have some time and grade to build up that kind of consistency. But they will tell you, hey, we don't charge an interest rate. We have a factor rate. And it might be, let's say, our factor rate is 1.2. And so you got to pay 1.2 times what you borrowed back. Well, if you do the math, which I've done, that implied APR ranges between 30 and 50%. So it's a very high priced option. But for established businesses today, a lot of millennials are using this if they can finance a project or a program with a customer that can complete in 6 months, that can be profitable enough after they've paid the interest. And so it's a very growing alternative to banking. The only other thing I'll mention is that equity funding, you've probably seen Start Engine on social media or TV. Mr. Wonderful Kevin Leary always advertises it. There's 50 of them in the United States today, but while they'll talk about startups, it's not for people that haven't broken even or have, in this case, you got to have 2 full years of audited statements to even apply to be part of this network. But again, once you get to that part, it's something you should be aware of. Now, as a reminder, we were going to focus on those areas that are shaded in red. So this is early stage startup, and that's where we're going to spend our time. Now, you've got all these financing pieces that we've talked about, this busy slide, which you've seen another time. But one of the things you're going to get afterwards is a picture of how startup funding works. It's a one-page picture that hopefully will bring all of these pieces together and help you see from beginning to end how it might work. Now, the picture is too big for me to have on one slide, so I have to toggle between 2 slides. So this is the top half. So we're going to talk about the various stages and then how the pie is split, which is the second one, splitting the pie and the stages. So to start with, on the far left side, as a founder, you've got 100% ownership, and it's 100% of nothing when you start, right? At some point in time, you might want to consider adding a partner. And at that point, you might add a partner and you go 50-50. So now you own 50% and the partner owns 50%. And at some point in time, you really need some money because you're starting to get some traction in the marketplace. And that's where family and friends can come into play. And at that point in time, you kind of say, okay, Uncle Fred, I need, $15,000 in order to, get to the next stage. So you get your $15,000 and you give up a 5% share of the business to Uncle Fred. Now, forget about the option pool. That has to do with employees, and it just confuses matter here. So we'll keep this rather simple. But after getting the $15,000 from Uncle Fred, 6 months out, you're starting to run out of that money. So now you need more money from another source. And you, at this point, you want to go to that seed round, which is really typically an angel investor. But here you really need some real cash. At this point, you think you really need about $200,000 in order to get to the next stage. So the angels will go through their valuation with you, just like on Shark Tank. And as it demonstrates here, for the $200,000 on the far left, they're going to value your business at $1 million. And what that means is now the 2 founders share the business decline. The uncles share the business declines. And now the angel, again, excluding the option pool, owns 16.7% of their business for the $200,000 investment. As time moves along, it's really been successful. You're steaming along, you're hiring people, but the business, in order to scale forward, you really need some big money now. So you've determined, look at the far left, you determine you need $2 million for the next stage of your business. And that's where you go to a venture capitalist. And you're persuading the venture capitalist and its crew that you need that $2 million to go forward. So they go through their valuation. And to get the $2 million, you've got to reach that $4 million valuation. And let's assume you make the test. But at that point, you can see that the founder shares have now dropped to 19%. The uncle is at 2.6. The angel is a little over 10%. And the venture capitalist has 33 and a third of the business. At some point in time, now you want to go big. And you're going to need a lot of money. And in this case, you think you need over $200 million to reach the next stage. And the only way to get there is to go public. So you're going to go public, and let's assume you get that $2.6 billion valuation. And what happens is your share goes down to 17%, the uncle down to 2%, venture capitalists at 30%, the angels at under 10%, and the public gets their 8.5%. But you've gotten your $235 million. So you put all of these sources together, and you started with 100% share of nothing, and you wind up with a 17% share of a $2.6 billion unicorn. So that's the way all of this stuff is supposed to fit together. And you'll get this picture as a follow-up, as well as the Family and Friends funding guide. And hopefully that will help the pieces fall together. So again, our purpose today was to learn a little bit more about how to fund your startup. I told you that we cover a lot of material, and I hope we accomplished a lot. If nothing else, I hope I made you think. So I want to thank you very much for listening, and I will stick around to answer questions. Thanks.
Great. Thanks, Jeff. A few questions that come in. Have you ever heard of Kiva? Is that a reputable source?
Oop, I lost you.
Can you hear me?
I lost you for.
Oh, no problem. Have you ever heard of Kiva? And is that a reputable source?
No, I haven't heard of Tiva. But if you wind up going to SCORE and find a mentor, you would be able to look to them to potentially find you feedback. The other thing is just I would go to the internet and just ask that question and see what answers you get. You'll be surprised.
Great, thanks. Would these concepts from today apply to a nonprofit startup?
Well, the answer is perhaps. I am not a not-for-profit expert, so I don't know. What we obviously didn't cover is anything that has to do with grants. The difference between the nonprofit and the profit companies is taking money out. And so donation funding is certainly applicable. Family and friends can be if they understand what the ramifications are in supporting a not-for-profit. The angels wouldn't be, and the micro lenders wouldn't be.
Great, thank you. Someone is asking if you could go 2 slides before this.
To what?
If you could put the slide to 2 slides. Can you repost the last
Oh,
two-part slide again?
This one? That's 2 slides.
The 2-part slide. Did you have one slide that you had to go back and forth to?
Right.
Yeah, I think they mean that one.
Okay, so this is the first one.
Great.
That's the second one.
Yes, that is the one.
And you'll get this in a PDF as a follow-up.
Yes, and this, for everyone who is asking, this webinar is being recorded and will be posted on BACP's YouTube page. I'll put it in the chat again, but it's youtube.com/Chicago BACP. Lots of thank yous. Thank you, thank you, thank you. Very informative, very informative. Who are the 7 angel investors in Illinois again?
Right at the bottom left. Cornerstone, Angel Food, Hyde Park Irish West, Heartland, MD.
Great. Do you know about the L3C?
L3C.
That's all it says.
No, I don't. I'm writing it down because maybe I should.
Sounds great. I'm getting a few questions on the certificate program. If you are already a part of the BACP Entrepreneurial Certificate Program, you will get credit for this automatically within 24 hours. If you have questions or if you want more information, you could go to www.chicago.gov/BACP certificate. A question is, what if you are selling services?
Well, I mean, there's really no difference in the sources for services. The reality that you have to recognize, however, is that service companies have only two assets, really. They have receivables and they have the people or the intellectual property. And so, with that in mind, obviously, the ability to get donation financing is viable. Micro lenders, it's possible. Family and friends, certainly, but you need to recognize that most lenders of capital are going to be thinking about, well, what kind of assets support the money I'm giving you? And in your case, with a service company, it's really your marketing, your intellectual property or people that work for you, and then the accounts receivable. So you're more limited in your ability, but your financing needs are also less than a production company.
Great. Oh, the L3C is a low profit limited liability company. Just as an FYI to that. Do you know of any funding for disabled veterans?
I do not.
You stated to wait to launch the startup until you receive funding. Is that correct?
Well, what I said was, don't launch your business unless you have enough money to do so. You don't have to have it up front. If you have done your homework and done a good job and gone to various sources, you and especially if you've followed the milestone approach, you wind up getting quasi-tentative or firm commitments of funding down the road. So you know that once you hire a social network hub, that Uncle Fred's going to give you $2,000 to pay for that. So no, you don't have to have it all up front, but you should know what your total cost burden is until you break even, and you should know where you're getting the money before you start.
Great, thank you. I am working on a POS startup. I am bootstrapping and don't want to take on investors, but they are approaching us to offer funding. Do you have a guide to vet VCs or angels?
What I would suggest on the angel side is go to that angel capital. The Angel Capital Association, and put in a search how to evaluate angels or angel groups, and I'm positive you will get information on that. And I believe that will be sufficient to help you kind of sort through other investor possibilities. But again, I would go to Google, go to DuckDuckGo, and just type in criteria for selecting venture capitalists or criteria for selecting angel group investor. And you'll get a long laundry list of options that will help you walk through that.
Okay, great. Thank you, thank you, thank you. Great insights. This is such great information. Very, very helpful. Great information. Jeff, you're very popular today. Just, I mean, one thank you after another. So think that is all the questions. I want to thank everyone for coming, and thank you, Tram from SCORE, and Jeff, thank you as always for such a great presentation. We always appreciate you coming on and sharing all this information with us. So
Well,
wishing
and thank
everyone a
you.
great night.
And good luck to everybody.
Thank
Great
you.
holiday.
You too.